Hello and welcome to another episode of a series of presentations. Yeah, hello, Mr. Shabu. We appreciate your being here on a Saturday morning, and today is going to be exciting, and we are going to discuss what we can do while the market is turbulent and we have invested in the market and the market is turbulent, what we can do in these times. Especially it gets very stressful for new investors if they start investing and see a lot of volatility and turbulence in the market. So we'll just begin. Yeah, today's agenda would be we would first try to understand what is market volatility and look at how it works. And then we would go to three ways of managing risks, how we can manage risks in turbulent market, and then how to navigate market volatility. And in the end, we will keep some time for question and answers. So market volatility, we see this chart of Nifty 50 for last 5 years. We can see how it has moved, and this was the time in the March 2020. You can see there is a big dip in the market, which was because of the onset of COVID-19 pandemic. And then from there on, market didn't look back, it just went up. And if you see the last 4-5 months also, like from September, October till now, till January 2022, then you see a lot of volatility happening. Nifty went on to touch new highs of around 18,000, 18,600 something in October 2021. And then within a span of 1 to 2 months, it went down to around 16,400 or something like that. So there was a dip of more than like 2,000 points in Nifty in the last like a couple of months. So this was huge. This was huge in terms of percentage and the kind of time span it took for Nifty to go down more than 2,000 points. So it can really spook new investors who have just started investing, because if they see their investments coming down, it can just bring in a lot of fear in them. So we will see why this happens, and then how we can navigate this kind of volatility in the market. So why it happens is generally, if you see, it's natural for economies to be volatile. It's the starting point, like it is very natural, and economies itself experience periods of contraction and expansion as well. So the contraction would lead to lower revenues for businesses in general in the economy, and that will bring down their bottom line, which is the profits of the companies. And also with the fixed overheads, also these factors amplify the reduction in corporate earnings. And another thing is that the markets also are very emotional, because they are consist of participants which are human, and of course emotions will come. They overreact relative to whatever is the actual expected change to happen in the economy. More than that, the market overreacts, and that happens. And it is the change in the stock market is sometimes very drastic when compared to actual change in the economy and the underlying business fundamentals, because of the emotions which ride in the market because of human intervention. So now how we can manage these risks? We'll just discuss three ways how we can go ahead and manage these risks, being the human participants in the market. So first is investment management. What people usually do is, even individuals and professional fund managers, what they usually do is, some people usually involve in active fund management, active investment management. So the first point here is tactical or as dynamic asset allocation. So what they do is, when they see a lot of turbulence in the market, they move their portfolio. They take out some money from the risky portfolio and move the money into considerably safer assets, like bonds. Or if they are very bearish on the market, then some people, what they do is they take out the money and just keep it in the form of cash for some time. This is done like on a regular basis, and depends on how the market moves and what people feel, what the actual fund manager is feeling. So this is about the tactical or dynamic asset management. So dynamically the asset allocation is done as the changes are expected in the market. So we will see further in this presentation how it works and does it really help or not. So another point here is that some people, what they would do is, like usually big fund managers managing funds, they would also be very country specific or sector specific at times. So they would try to find out which countries are going to perform better in future, or which sectors are going to perform, and they would take out money and put in those sectors where they are bullish, and take out the money from sectors or countries which about which they are bearish. So this is also a continuous process, and it requires very active management of funds. Then if we zoom down a little more, then we see, of course, the stock picks in the country and sector specific thing. We see people picking particular stocks, and they kind of predict that which stock is going to do well in future, and they put more money in those stocks which they feel are going to do better in future. So these are all part of very active fund management, and most of the fund managers usually pursue this, and even some individuals pursue this method to manage their own investments in the market. And of course this would include, like to some extent, timing the tops and the bottoms in the market or any particular sector or stock. But this is very difficult to do, and to catch the actual top and bottom is quite impossible. And this also leads to a lot of stress and anxiety among people who are actually trying to chase the actual tops and bottoms in the market. And it is also like, if we see empirically, there is a lot of evidence that this isn't so fruitful. So we will see how we can see. We have a lot of evidence through data to support that this kind of active fund management is not so fruitful when compared to the time and effort it requires. So this is the data of large cap open-ended equity funds, and we see how they have performed over years. So if we see in the last 1 year, so we have compared them with a benchmark index. So for some, the benchmark index is Nifty, and for some it is Sensex, and depending on the fund category, the benchmark has been chosen. So for some it is Nifty 100, and for some it is BSE 100. So we took all the large cap open-ended equity funds in the Indian market, operating in the Indian market. So if we see the performance of 1 year, we see that more than 50% of the funds were able to beat the benchmark index. But when we go to longer terms, say 3 years or 5 years, we see that the performance of the funds in 3 years, less than 30% of the funds were actually able to beat the benchmark index. And if we see for over a period of 5 years, last 5 years, we see that just a little more than 10% of funds were able to do that. And of course for 10 years it is little higher, less than 30% then also. So we see that despite being very active in the market and spotting the opportunities which they feel are good, they are not able to match the index performance, and most of the funds are not able to match even the index performance. They are performing poorly than the overall index in the market. So this suggests that active fund management is not as useful as it is thought to be. Another important point is about persistency. So people would say that the argument would be that you spot the fund managers who are doing better and put money in those funds, where the fund managers are performing better over a period of time. But here there is a lot of trade-offs between kind of luck and skill. So if we see the performance of mutual funds in the Indian market, then let's just see how it goes. So I have just taken the screenshot of all large cap funds, and we see the top 5 funds, how they have performed. So if we see in the first year, like 1 year performance, if we see the first column, if you see after the legal name of the fund, the 1 year and 1 year performance and the rankings. So you see the top 5 funds according to last performance of last 1 year, how they have given the returns. And then you, as you move to the second year and then see the ranking, the funds which were in the top 5 are falling in their ranks have deteriorated when you see a 2-year performance of the same fund. So you see the fund which is in the 4th place in the 1 year performance is in the 42nd place in 2-year performance. And then you just move on and see 3-year performance. Then you see that the fund which performed the best in the last 1 year is ranked 9th according to 3-year performance. And the fund which was second when you see the last 1 year performance is ranked 23rd. So like this, if you go and you see 5-year performance and even 10-year performance, I think many of these funds did not exist 10 years back. So many blanks are there. But then still the point what I am trying to make is that the persistency in the performance is not up to the mark. And the same fund managers are not able to repeat their performance over the period of years. So I mean, sometimes some people would get lucky in a few years and then their performance would be looking as if they have performed really well and outperformed the market. But many times it would be like outguessing the market more than outperforming the market. So it is a lot of luck which also plays its role when it comes to performance in the market. So choosing a particular fund manager who has performed consistently over a number of years, say last 10 years or something, is quite difficult because those things kind of do not exist as the evidence suggests. So what can be done here? Is it not a good way to invest in these kind of funds? No, it is not like that. They of course do well, but the thing is that we are comparing them with the benchmark index performance. So when we compare with that, we would of course want, if we are managing the funds very actively and putting in time, effort and cost in that, we would of course want returns which are little better than what market has to in general offer. So if you see from that perspective, the performance does not seem to be quite great. So what we learn from history here, what we learn, we see that major crisis happens every now and then. This COVID crisis happened in the year 2020 in the market. Before that, the major crisis was in 2008, which was the global financial crisis. And before that also in 98, 99, there was a crisis because of the Southeast Asian markets. So, and also that there was a dot-com bubble around that time. So a dot-com bubble burst. So these kind of things happen in the market, and these are some of the major events, crisis which happened in the market, global market, so to say. So then we see that market always recovers. How much ever the crisis is bad, how much ever bad it is, the market has always recovered. And another interesting point here is that the recovery time taken by the market, the time to recover from the lowest point, from the bottom, is becoming shorter and shorter with progress of time. Like if you see the global financial crisis of 2008, that time the markets went down. It took almost a year around that time for the markets to come back to the same level. And if you see the time taken during the COVID-19 crisis, the market went down in March 2020. It almost took like two months or around that time for the markets to come back to the same level. So over period of time, we have seen that the markets always recover, and they then cross new highs. They make new highs, and also the time taken by the market to recover is becoming shorter and shorter with time. And the trajectory, stock market has its own trajectory, which is in the long term always going up. So why is it happening? There are a lot of reasons. The reason is because the stock market, it depends on the price of any stock depends on, of course, the expected future earnings. So we see the increase over time, the earnings of good companies, nicely managed companies always grow. So the earnings increase, and the earnings increase because the demand of their products increase. And why this happens in general is because of the population growth and rise in the standard of living across the globe. So as these things happen, the earnings of the companies grow, and the stock market also grows in the longer term. So this is an important chart. I would say this gives us a lot of insight. So this is what I have done is I have taken a 1 year return, the returns which Nifty has given over the last 25 years or so. So if we see from 1996 to the year 2020, what it is showing is the return which Nifty has given over a period of time. So if you see the first column, which is the year 1996, so you see if you invested in the year, say 1995, then in 1996, at the start of 1996, if you just invested in Nifty, your money would have grown by 4%. And if you stayed invested over a period of 2 years, then from 1995 to say 1997, then your money would have grown by 20%. But if you would have stayed invested for 3 years and started again back in 1995 and stayed invested for 3 years, then your return on your overall investment would have been -1%. So this is a cumulative growth which I have shown, not the annualized growth. So you see that if you go to the second column, it says that if you started investing in 1996 and you just come to 1 year return in 1997, then your return would have been 15% if you just invested in Nifty at the start of 1996. So same way, if you stay invested for 2 years, your overall return would have been -5%. So same way it goes, and it goes till 2020. So if you see the horizontal line which it is making from 1996 to 2020, the the top column, the topmost row in the each column is giving you one year return, and then the second row in each column is giving you 2 year return, and then the third row is giving of course 3 year return, and so on and so forth. So if you see how the color pattern is showing the range in which your return varies, if you see then you see some red boxes here and there along the horizontal line, and as you move further down each column, you see that it becomes more greener and greener. So what it says is that if you stay invested in the market for a longer time, then you don't have to do anything, and the markets will do its own work, and returns will come to you. So if you see the red boxes, you see around year 2000, 2001, there are a lot of red boxes. And then around year 2008, 9, there are some red boxes. And yeah, so the year 2000 and around that time there was this dot-com bubble burst, and then that 2007-8, that range, this was the global financial crisis. So there you see you have three four boxes where your returns are in red. And after that, as time passes and you cross 3 4 5 years in the market, then you see that your returns obviously come to green. And then as you go down in time, as you go forward in time, your returns are overall returns throughout like the whole period are becoming bigger and bigger. So what this chart suggests is this black line. If you see this black line which is going cutting through this graph, if you have invested say 5 6 years in the market, if you stay invested say 5 6 years in the market, this is just for 25 years. But if you take like the markets from if you say American markets, or yeah, American markets for last 100 years, you will see the pattern even during the Great Depression, how it happened, and other crises which happened in the past. So this is the data from Indian market, so just last 25 years. So you see, if you just stay invested for say, if you cross 5 to 6 boxes and stay invested for 5 to 6 years, then all the boxes beyond that are in green. So it says that it doesn't matter, like when you start, it doesn't matter really. If you are invested, if you stay invested in the market for a longer period of time, then your returns are going to be there. Your market is going to give you those returns which it has to offer. And these turbulences which are happening in the market are short term, and you have to ignore them and just stay invested. So it actually doesn't matter like when you are starting. And yeah, you have to just stay invested and give time to the market to do its own work. So the recommended time horizon ideally would be, if you are aggressive and putting all your money into equity portfolio, then on an average, if you can give 10 to 15 years in the market, then you can expect to have a good return in the market, and kind of go through all the turbulences in the market and still be in the market and have good return on your portfolio. And if you have a balanced portfolio where you are keeping some money in the debt side and rest of the money in equity, then 8+ years are good enough to see decent returns in the market. So what you should ideally do over a period of time in the market and not timing the market. And discipline is the utmost important thing. So you should continue to invest regularly. Whatever happens in the market, continue to invest regularly. And these turbulences which happen on and off in the market, if you don't withdraw, if you don't liquidate your savings that time, then these are just your temporary paper losses, right? Because you have, these are unrealized losses. If you invest today and the market goes down in the next 2 3 months and your portfolio is in red, and you have not actually liquidated that portfolio at that time out of panic, then that is just a temporary paper decline. And if you liquidate them, then those would be actual losses. But if you stay invested and remain calm and stay invested in the market, then later on the market will of course move up, and these paper losses will then convert into actual profits. So stay invested in the market, and don't turn temporary paper loss into a real permanent loss. That is the key to investing in stock markets. So this is this is interesting. Usually they say that the best time to invest in the market was kind of 15 years back. So what is the second best time to invest? So second best time to invest is today. And if you start investing today, like you have not done it in the past and you start today, then you have the longest possible time. And it takes really small time. Like you can just start now, everything being online, you can just start in 10 minutes. So if you have not started, the best time to start is today. And then this is about this was about the investment management. Now we move to financial management. So every person has his own equation with money. So this slide is a little busy, so let's just see it in a little more detail. So what happens in the short term is that we have an income, right? Everybody earns, everybody does some job or some business or something which gives them regular income, and that is the most important financial asset for anybody. So it is recommended that you keep that job uh, try to become so good at your job that nobody can ask you to leave. If you are into a job where you're working for a company or you're working for an organization, then be good at it, add value, add skill to your own self, hone your skills, and be so good at it that nobody asks you to leave, and keep your job and keep growing your income. Then whatever you earn in the short term, that of course some part of it goes into savings, and the other part, the rest of the part goes into fixed expenses and variable expenses. So the savings portion is what goes into the long term, or what you transfer and start investing, and then this goes into your long term savings and investments. So increase your savings and control your expenses through budgeting. So do a budget. Since you have a fixed income, kind of a fixed income, or even if it is a variable income, then save as much portion as you can and do budgeting, and try to figure out what your fixed and variable expenses are on a monthly basis, and save as much as possible and transfer them towards your long term investments. And also it is important to be insured, because if you have especially if you fall into some medical tragedy, something happens at home where you fall into some medical urgency, then your plan shouldn't fail because of just having huge medical expenses. Your overall plan for transferring wealth from short term to long term shouldn't fail because you are not insured. So insurance will take care of these one-off unseen and unplanned expenses. So be insured, especially I'm talking about medical, I mean health insurance here, because medical expenses are huge these days. And also try to insure yourself towards loss of income just in case it happens. So try to have some kind of critical illness or those kind of insurances, so that even if you have loss of income, then you don't have to liquidate your investments soon. And if at that point in time the market is down, then you don't have to liquidate your investments, and you can manage your personal finance through this money which you get from insurance company. So this is what you can do. And then of course your returns will multiply over the years, and they will just help you to meet your future goals. So stay invested for long term to get returns you need, and this will help you stay rich. And what you have less control over, so whatever happens in the long term, you have less control over there, because the markets of course, as I said, will give you returns. And if you stay invested for longer term, the markets will give you returns and to fulfill all your goals. But what you have more control over is what happens in the short term. So what happens in the short term, please be aware of it, and please take cognizance and try to save as much as possible, and invest the money towards long term investments. And this is the portion where you have better control, and this will help you to become rich and have more money in the future. So let's move on what all you can do. So the first point is like, just keep your job, become good at what you are doing, invest in human capital, and which is you, of course, for your own self. And then don't try to increase your debt, or don't try to buy big ticket items, especially in the times of stress. You can always do that later when the times are better. And make sure you are insured against any medical emergency. have emergency fund of 6 to 12 months. So if the times are bad, if you have this fund, then even if I mean you are in lot of stress, you don't have to liquidate your long term savings or long term investments. So this fund will take care of your short term needs, even if you are not earning, or you have lost your job for some reason, or you have some kind of variable income which is not working well for shorter time. So have emergency fund. This is of great help in times of stress. Control your expenses, and for retired people it is important to manage cash flow, because retired people of course will not have any income inflow. So they have to manage from whatever they have. So they have to keep on liquidating some of their savings or investments every month for their monthly expenses. So when times are stressful, then they have to see how they manage it, and maybe if they can manage with lesser money for some time, then liquidate less of their investments and manage for some time. So it is important for retired people because they don't have any source of income. So they have to see their cash flow management and try to liquidate as less as possible when the markets are down. So now the third point is self management. So it is the most important point, because most of the people don't are not able to manage their own behavior when it comes to investment in the market, and that leads to most of the stress and anxiety and big losses in the financial markets. So the problem is that your head always knows that, okay, whatever I have told you, maybe you know intuitively that whatever I have told you is true. But when it comes to actually implementing it in the market, then your heart says something else. When you are actually in the time of stress and panic, then you don't listen to your head, and your heart says that, okay, now the times are very bad, now the market is not going to recover. And then you start just panicking and liquidate all your investments. This happens all the time with most of the people. So what we know intuitively, also what is the very basic information, also we forget that when we are in I mean in the times of stress, we forget that, and we try to act in the flow of emotions, and we panic, and we try to withdraw our investments. So what we can do is, we can first thing is that we can recall the evidence and logic about the markets. We can keep ourselves always reminded that what we are feeling is not going to work. Feelings are separate and the market is separate. Market doesn't work that way. So we can always try to remind ourselves. And another thing is, we can have a coach, we can have an advisor who is competent enough. And the role of the advisor is more of to control your behavior in the market than to do anything else in the market. So the advisor who is competent enough and has good experience in the market, what he can do is he can keep you reminding, he can help you with the first point. He can always keep you reminding that, okay, this is the time of stress, but this too shall pass, and no need to worry, no need to panic. So have a competent advisor who would help you with the first point, and coach you in a better way, and help you navigate through the times of stress. And then this third point is important. This third point is a little different, but yet it adds a psychological edge, that if you have some dry powder to use, and what it means is that have some extra money with you. If you have some extra money with you, more than what you have in your emergency fund, or in savings, what you think is you can invest in the market at that time when the market is I mean volatile and going through bad times. Then use that money to invest at that time in the market. So what it does is it gives you a boost. It gives you a psychological boost, and you feel that, okay, when the markets are down, then I have invested some more money in the market, and of course I got to buy some good stocks at a very good bargain. So this of course will not do anything but give you a psychological edge, because instead of withdrawing your money, instead of liquidating your investments, what you have done is you have done the other way around, and you have put in extra money in the market at that time. So you will of course feel good about it, and you will not think of further liquidating. And And of course, as time goes and market goes up, you will feel good about the investment in the decision you made. So if you have some dry powder, if you have some extra savings, if you have something over and above your emergency fund, then use it at this time and make some extra investments than what you are making regularly in the market. So this is nothing to do with anything else, but to more to give you a psychological boost as an investor in the market. So this is about self management. So what we have learned, the summary, just we'll summarize this and move on to the next important point. So just stay invested and keep investing regularly, make good financial planning decisions, and an advisor, keep an investment advisor, get reminded, get advised, and capitalize on opportunities. So this was the last point which I discussed in the last slide, that when the markets are down, you have some extra money, use that, capitalize that opportunity, and invest some extra money at that time. So this will help you go through these bad times really well. So now this was all about managing your self, your behavior, and just we saw how active management is not going to help so much. But let's look at another point, which is very data centric approach. So is it not possible to earn returns which are better than the market returns? Is it not possible in the market to earn returns even through active management? We have seen that the fund managers are not able to do so. So why it is happening, and is it not possible to earn returns which are greater than the market? No, it is of course possible. So how we can do that? What is the way to do that? So see, this is the daily return of Nifty. So I made this chart. So you see the daily returns of Nifty over the last 25 years. So it's if you see, most of the times the returns are this is the line around zero. So most of the days the returns are hovering, say, between 1 to 2%. And then you see there are times when the returns are going even beyond 10%, or in the recent time also you see around 2020. If you see a lot of volatility in the market and returns are going say more than 10%. So what we see here is that when the market is volatile, it is both sides. It is not that the dots are coming on the ones on the higher side or on the lower side. Whenever there is a dispersion, whenever there is movement away from the mean, then it is on the both sides, above the line zero and below the line zero also. So we see that when the markets are volatile, they move both ways. It is not that the market is always going down or the market is always going up. It is not the case. Whenever the market is volatile, then it is moving both ways. So what happens is that if for a few days the market goes down, then if that time we liquidate our investments, then we lose the opportunity which comes along with this volatility, when there are good days and the market really goes up. So so the point is that whenever there is volatility, the movement is both ways. So to capitalize on this upside movement, what we have to do is simply keep keep invested in the market, stay invested in the market, and not to liquidate the investments. Yeah. So market, what market does is it just combines all the knowledge of all the participants in the market. So market is effectively enables competition among many market participants who voluntarily agree to transact. And the trading aggregates a vast amount of dispersed information and drives it into security prices. So a lot of people around the world are coming and they are voluntarily trading in the market. They are trading on their own with their own perspectives and what they think about the market, and they are placing the orders. And this amount of information which is coming into the market from all these people, this is actually driving the prices, right? So a lot of knowledge is being incorporated in the security prices already. So what we can do to get that extra return, if we want, what we can actually do to get that extra return. Is it actually possible to get extra return which is expected when we actively manage our funds? Yes, it is possible. So we have to actually focus on what are the dimensions of expected returns, what are the drivers which drive the returns. So of course, what is expected return? Expected return in the prices are the prices we pay to buy any security, and then in the future what we expect to receive from that investment. So the bigger the gap in these two things, the higher will be our expected return. So the idea is to buy low and then to sell when the prices have gone up. And so if we buy when the prices are low, or buy any security where we expect big returns in big cash flows in future, then these will drive the expected returns in the market. So dimensions that point to systematic differences in expected returns. So we always know intuitively, we always know that there are certain stocks or there are certain sectors which are going to give higher returns when compared to the benchmark index, right? We always know intuitively. So what are the drivers which drive these expected returns? So I've just listed four of them. Of course, the market, if you see, market itself gives you a premium, because if you compare stocks with bonds, so bonds will give you lower return compared to stocks. Everybody knows that, it is a very basic information. So stocks are risky investments and they are expected to give you higher returns when compared to fixed income investment. So there is a premium associated with investment in the stock market itself, equity market itself. Then comes the size of the company. So we all know that mid cap and small cap companies are riskier companies, when riskier investments when compared to blue chip large cap companies. So the size of the company also matters, because when the companies are small, they have big chances of growing in the future, and also there is a downside risk that they might not survive in the market and go to the ground. So there is a bigger risk associated with small and mid cap companies when compared to large cap companies. So the expected return from mid cap and small cap companies is of course higher when compared to these blue chip companies. So this company size also drives the expected return. Then there is relative price also, how the company's stock is priced at that time. This is more important in value investing, because some companies prices will be lower, the market will keep their prices subdued because of many other reasons, and it will not be correlated to the earnings which they are showing. So the relative price of the stock also is important. So that means that you are getting that stock for cheap, and the expected cash flow from those companies are going to be good in future. But still the prices of those companies are low, so they fall into value investment category. So here also you can expect to earn good returns if you stay invested in these stocks for quite some time. So you can expect to have better returns more than what market has to offer. And then the last point of course is profitability. So this is the ultimate thing which drives the price of any company's stock. So high profitability companies of course will be able to give you higher returns in future, higher expected returns in future. So these are some of the drivers. So what you can do here is that you can see these drivers, you can spot the companies based on these drivers and invest in these companies, these kind of stocks. Then you can expect a return which would be higher than your benchmark index return. But to spot the companies based on these factors and to invest in them, or to spot the sectors or the countries based on these factors itself is a tedious task, and it is very time consuming. And of course, when we are expecting better returns, then we have to take more risk also. So in the shorter term, of course, it can give some stress in terms of earnings, in terms of returns. So we have to see, like we have to make a balance, like how much time we are putting in and how much more expected return we are getting. But of course it is possible if we go through, I mean, if we go in the line of these dimensions, these drivers, then we can earn return which is more than what the market has to offer in general. But we have to do the research, we have to put in the time and effort, and we have to take that anxiety and stress which comes with the investment in the stock market. So yeah, so this is what we can do to be considered a dimension of expected return. So how we can see, how we can determine the dimensions, the drivers of expected return. So you should have the investment which you are making should be able to give you extra return, which is the premium on that investment. The driver should be like sensible, and it should be some sensible driver, right, which is actually affecting the premium of that stock, the premium associated with that stock. And it should be persistent and pervasive, robust, and cost effective. And cost effective is also important because whatever we are doing, there is cost with the associated with that, in terms of like the transaction cost as well as the time and effort which you put or your investment advisor is putting into that. So it should be cost effective, and the dimensions should be robust. They should be giving you returns, I mean the premium in expected returns on a continuous basis, on a robust basis. So also on this, in this way you can have even more dimensions, but these are the major ones: market, company size, relative price, and profitability. If you just go through these drivers and spot stocks, then you can expect to have better returns when compared to the market. So the last thing is that what you can focus on is focus on what you can control. So create an investment plan to fit your needs and risk tolerance. So just create a plan which is fit to with which fits with your needs. That is the most important thing. And risk tolerance is also important, because some people will just try to chase the returns and put money in the stocks or in the investments which are much riskier than what they can take. So they have to, of course, go through a lot of anxiety and stress, and yeah, of course the financial stress comes along. So create a plan and invest according to your needs and risk tolerance, and structure a portfolio around the dimensions of expected returns. So this is important. If you make a portfolio around these dimensions, and of course you can get a return which is better. And diversify, this is important, and they say that diversification is the only free lunch which you get in the market, because if you diversify, then you just mitigate all the systematic risk which is present in the market. So just diversification, it doesn't take much time and effort. So you can diversify across sectors, you can diversify across markets, you can diversify across countries. So diversify as much as possible, but of course there should be some optimum level. And just remove all the systematic risk which is present in your portfolio. Manage your expenses, turnover, and taxes, and stay disciplined through the market. And through dips and swings, it is most important to stay disciplined at the time of dips and swings. Those are the times which create stress, so it is important to stay disciplined in those times. And yeah, if you are not able to manage this, it is better to have a financial advisor who can offer you help, expertise, and guidance to focus on actions that add value. So what an advisor can mainly do is, he can focus on your actions which add value to your investment and which can lead to a better investment experience. So yeah, this was a short presentation. So here we come to almost the end. So about Algates, so yeah, Algates Financial Private Limited is authorized person of Cholamandalam Securities. We deal in investment in stock market, and of course bonds and corporate fixed deposits in fixed income category. And then Algates Consulting IMF is insurance marketing firm. So we distribute products of insurance companies, and we provide end-to-end financial service solution, financial planning solutions to our clients. to fulfill their financial goals and needs. So we believe in providing best services to our clients through dedicated team of relationship managers. So we focus individually on each and every client, and every client is important for us, and we have dedicated relationship managers who take care of their portfolios. So this is about us, and you can reach us through, you can call us, or you can visit our website, or write a mail to us. So let's just start with the question and answer. So any question you can ask in the chat box, or active management can have big risks, and you may miss out if the market has big run. Yes, true. Active management is having risk, and that is why we see that most of the fund managers have not done well when compared to even the benchmark index. Because when you are actively managing your fund, we saw that how the markets behave. When there are swings, it is not the swings are not one sided, they are both sided. They go markets go up and down. So if you are actively managing your fund at that time, if you are actively managing your portfolio at that time, and not staying invested in stocks where you have already invested, then you might miss out on the big run in the market. Of course, if you just actively managing and you liquidate your fund, or you become very bearish, your point of view becomes very bearish, and you think that, okay, the market is falling, so let me liquidate and keep some money in the cash, and I will invest later. So then that means that you might just miss out on the next big run which is about to follow, so about to come. So yes, these are the negative points of active management. You are right. So any other question is there regarding this, or anybody can unmute themselves and ask, or they can ask in the chat box. No. Thank you very much for joining in. It is really good to see that some people are joining in every now and then, and in each and every presentation which is happening. So thank you very much for giving us time. How would you evaluate a company? So there are many ways to do it, but the two basic schools of thoughts are fundamental analysis and technical analysis. So we did a presentation on fundamental analysis sometime back, like last month, and so that is one way to evaluate a company. And then there is technical analysis, which checks the which is completely based on the past history, and how the prices of the stock have moved in the past, and then they make the chart, and it is also called charting. So then they make the chart and draw trend lines, and find out whether in the future the trend line is to follow or to break, or where the stock price will go. So these are the two schools of thought. So fundamental analysis, already we have done one presentation. If possible, we will elaborate on that. And technical analysis we'll try to take up in future if possible, and we would see how we can take up these topics. Both of these can be high risk. No, not exactly a high risk. It is just a way of evaluating company. These are just the ways of evaluating a company. Ultimately, it will depend on the company in which you are investing, whether the risk is high or less. So generally, if you are investing in stocks, the risk is higher compared to when you are investing in fixed income securities like bonds, or if you're keeping your money in bank deposit. So risk is higher when associated with the stock market. And in stock market also, when you are investing in large blue chip companies, then the risk is lesser. And when you are investing in small cap and mid cap companies, then the risk is higher. So risk is different. So these are two different ways to evaluate company. So it has nothing to do with risk. Risk will come along with the company, or along with the sector or the market in which you are investing. These are just the ways. They have nothing to do with risk as such. ETFs, ETFs are simply, I think this question came up last time also. ETFs are simply exchange traded funds. So suppose if we are if we are investing in one ETF which is I mean based on Nifty 50, then simply we have to if we are going through technical analysis, then we have to see the charts of Nifty. Simply we have to see the charts of Nifty, and we have to see how it is progressing, and what it is going to do in future, how the trend lines are, where are the levels, what are the support levels, what are the resistance levels. And we have to simply, we can't evaluate ETFs, we have to evaluate the benchmark index which it is following. So all the ETFs will be closely matching the returns which are made by the benchmark index. So Nifty ETF will match the return given by Nifty, Sensex ETF will match the return given by Sensex. So like that, so you have to evaluate the benchmark index, and then out of various ETFs, you can, suppose you are going to invest in Nifty ETF, then you can see among lot of ETFs there will be some errors. So which ETF is having less errors, which is following the market more closely, you can invest in that. But you cannot evaluate ETFs as such, you have to evaluate the benchmark index. And for index, you have to simply go by the general economy or the market, and you have to do the technical analysis. You can't do so much of fundamental analysis in that, because it is not a company, a specific company or a sector, unless you are in a sectoral index. So you can do some technical analysis, or also if you have to do fundamental analysis, then you can do some macro analysis based on economy or the sector or the market in general, because there is not only one company involved. An index will have so many companies, like Nifty has 50 companies, Sensex has 30 companies. So so macro fundamental analysis can be done, and other than that, technical analysis can be done, which is based on the underlying index charts. So this is how you can evaluate ETF. That's what I feel. Yeah. So any other questions? Thank you so much for the appreciation. Yeah, thank you so much for appreciation, and thank you for joining and giving us time. This matters to us, and we would continue this series of webinars, and we will keep you posted when we are coming up with the next for our upcoming webinars. We'll keep you posted. Thank you so much, and have a great day ahead.